Whirlpool shares are on the move this morning after the appliance maker trounced Wall Street sales and profit forecasts. The company credited strong demand for its appliances globally and the benefit of recent price increases. Whirlpool also jacked up its full-year profit forecast by $3 from the midpoint of its prior range. Joining us moments after wrapping up his earnings call this morning is Whirlpool Chairman and CEO Marc Bitzer. Marc, good to see you again, as always. I was on the call this morning, and the team called out a $1 billion hit this year from inflation. Does that type of level of inflation, will that continue into next year?
So first of all, thanks for having me back on the show. Yes, we kind of reconfirmed our outlook for raw materials, which is a $1 billion headwind. We saw that coming already at the end of the Q1. It's something which we have to deal with, and we've dealt with because we have raised prices across the globe, anywhere 5 to 12%, and we feel we're in a pretty good position to mitigate the effects of a raw material. Having said all that, and that's just, of course, with a lot of uncertainty, but just coming in what we see right now from raw material, there will be some carryover effect also in 2022, and we will see some inflationary pressure continuing into 22. The magnitude, it's too early to say.
Marc, do you think you will have to raise prices again this year?
I mean, right now we feel we're in a good position to deal with what we so far saw coming, and we've been pretty predictable also in terms of raw materials, and so it's now been pretty stable in terms of our outlook. So right now we feel we're in a pretty good position, but I would just say, judging from the past, when we see certain things developing and certain trigger points for price increase, we act. We don't wait, we act. Ultimately, our job is to protect our margins as a company, keep a healthy company, and that's what we've done with in the past. So if there would be changes, we would react accordingly.
Marc, we've kind of started this conversation talking about the supply side of the equation here, challenges on, getting the goods you need, the pricing there. I'm curious about the demand side of the equation, what you're seeing, from consumers and also from, maybe the commercial market as well, and where your end, markets, how they're kind of looking today as we sit here in July 2021.
Yeah, so let me maybe zoom out a little bit. The term I use also internally is kind of, we're living in an upside down world. And what I mean with that, kind of, we all pretty much grew up in an environment you had excess supply and you had to create the demand. Right now it's the opposite. You have almost excess demand and you have to create the supply. And that's just something which we all get accustomed to and used to. On the pure demand side, we are actually seeing the demand very sustainable and also in the long term. Now, obviously, with regional difference, but in particular North America, we just increased our demand guidance for this year for the industry. And I would also say for 22 and 23, we do see strong single-digit market growth going forward. And that's ultimately, particularly in the US, driven by the housing demand, despite its ups and downs, which is more driven by housing inventory, is strong and will remain strong. And frankly, the housing markets need several years of solid and strong supply to just rebalance supply versus demand. So short answers, we're very bullish on consumer demand, and that is not going to be our issue the next year and coming years.
Marc, it's Julie here. What about the cadence of that demand? In other words, yes, we've seen a hot housing market here in the US. We've also talked a lot about how people can't get certain appliances in the time frame they want. Have you seen people delay their purchasing decisions on your products as they wait for more supply to come in?
No, Julie, short answer is no, we haven't seen consumers waiting for it. And typically around this time of year, normal years, people would maybe wait to see what Labor Day deals or Black Friday deals there are. To any consumers on the phone, don't wait, because there's not going to be a lot of deals on the market. So having said all that, no, we did not see delays. Actually, it's quite the opposite. And we don't feel good. We're letting consumers down because we have consumers waiting way too long for our appliances, and they need the appliances because, it's what many people right now confuse in the discussion. It's not like people pull forward demand. People have been using appliances a lot more over the last 1.5 years than any time before. So you just have a higher consumption. So people need to replace certain appliances. And we feel really bad about having so many consumers waiting for our appliances.
Marc, there was a good discussion on the earnings call this morning about market share and concerns among analysts that you have lost floor space or market share, but you're saying it's more of a supply issue.
Yeah, it's entirely a supply issue. And first of all, to clarify, we have not lost floor space. Our products are very strong. We feel extremely good about the innovation which we brought to the marketplace. if you're particularly producing in the US or North America, you're more faced with supply chain constraints than, for example, if you produce in China. And right now, so sequentially, we've in the US not been able to gain market share, even though we wanted to gain market share. And that's largely driven because right now you have less constraints coming through China imports than if you produce in the US. And we have a very low share of China imports in our business, and that's just what it is. I'm not nervous about that because we consider that temporary. Because again, we know what the consumer floor space is, we know what consumer preference for our brand, so we structurally feel very good. And but of course, we're still frustrated that we can't fulfill all the demand which we have generated.
Last time we talked to you, Marc, it was smack in the middle of the pandemic, and folks were buying those KitchenAid mixers like the one pictured right behind you. Now that folks have gotten more mobile again, what are they buying?
I mean, it's pretty much across the range. And then again, it comes back to, I would say, as we've gone through this pandemic, so initially you just saw the typical pre-crisis purchases, freezers, fridges just for the garage because people want to store. Then we saw particularly a lot of stand mixers. People were baking, cooking at home. And now, frankly, it's across the range. And it ultimately comes back to, you just think about yourself, think about your friends. People are spending significantly more time at home as compared to the office or other premises. And that just drives appliance consumption. You just use the washer a lot more, you use the oven a lot more. And on top of that, there's quite a bit of, we all know there's disposable income. The households have cash available on their checking accounts. So you have disposable income, a general reorientation of the consumer to the home, which will not go away because people just spend more time. They're willing to invest in the home because they can't invest the money on international travel or whatever else. And that's what we're seeing across the board, and we don't see that going away very quickly.
Full disclosure, Marc, I still can't bake, but it's not the KitchenAid mixer. It's just Brian Sozzi. I just can't get it done, but I could make you a hamburger.
Hey, we have some good cooking training classes. I invite you to join one of them.
All right, fair enough.
I may join you because I'm not a good cook either.
I may take you up on that. Always good to see you. Whirlpool Chairman and CEO Marc Bitzer, stay safe. We'll talk to you soon.
Welcome back to Yahoo Finance Live. I'm Adam Shapiro. Southwest Airlines reported second quarter earnings this morning. Revenue of $4 billion beat expectations, and the company also posted a profit with the help of some of the payroll support program and government support in the month of June. But to help us break down where the airline is headed, we invite back into the stream CEO Gary Kelly from Southwest Airlines. And Gary, it's always good to see you. Thank you for joining us.
Good morning. It's great to be back.
You called the second quarter a pivotal quarter in the pandemic recovery for the airline. And you also pointed out that in June, leisure travel demand exceeded 2019 levels. Is this sustainable going through the third quarter?
It looks like it is. We lost, if you take out the government support, we lost $1 billion in the first quarter, and we cut that to a loss of only $200 million in the second quarter. So it's a substantial improvement. Our revenue is almost doubled compared to the first quarter. So yeah, I think that we can sustain that going into the third quarter. I think we're all worried about this Delta variant, but right now we're not seeing any impact whatsoever on our bookings from that. So it's very encouraging, and we're in a stronger position here in July than I thought we would be 90 days ago. So we're feeling really good. We've got some operational challenges that we're working through, and we'll certainly get things smoothed out there. But yeah, demand looks really good, and I think that we've got good momentum for the rest of this quarter at least.
I want to talk about the return of international flights as well, because you have destinations to Mexico, to Cancun, as well as to the Bahamas and to Jamaica. But real quick, you also announced in the earnings report a return, or the $85 million of profit sharing for the employees. And we should point out, not one Southwest employee lost their job during this terrible pandemic we've all been going through. Wouldn't it have made sense perhaps to preserve some of that cash and maybe wait just a little bit longer before profit sharing?
Well, that's the contract we have with our employees, so to speak. And it's a moral contract. Yeah, it's a discretionary decision by our board of directors. But we do include the proceeds from the federal government and our earnings, as you know. We were profitable in the first quarter, including those. We were profitable in the second quarter, including those numbers. So we feel like it's only fair to let our employees share, as they always have, in the profits of the airline. So, and by the way, on your comment about the month of June, we were profitable in June without the payroll support from the government. So it's a very good sign going forward.
Will you be able to be profitable, do you think, for the full third quarter without, I don't believe there's more payroll support, but some of your peers have talked about profitability in the third quarter. Is that in the future for the airline?
There actually is payroll support that is roughly equivalent to what we earned in the second quarter, again in the third quarter, just the way the accounting works. But without that, yeah, I think we have a good shot at profitability, assuming that demand continues to be strong.
Let's talk about some of the demand, because you've also set a goal of total resumption of international flights, such as those to Cancun and to the Bahamas, come early 2022. I realize that there are some unknowns with these new variants, but do you think that you will achieve that goal in early next year?
I think we will. We're having good results with our international flights as we speak. And of course, every destination is a little different, but that's the plan. And we haven't seen anything thus far that would cause us to want to change our plan.
I want to talk to you, too, about the news of the transition that's coming in 2022 and the choice of Mr. Jordan to take the role as CEO. You talked about this being bittersweet in a chat you posted on the Southwest website for you, because after 18 plus years, you've seen the best, the worst, and then let's say the best again of the airline. Why make this transition now?
Well, 18 years is a long time. And I think change is always good, and new and fresh energy is always a good thing. And change in that regard is inevitable. I'll be 67 next year, and Bob's not getting any younger either. He's got a 33-year career under his belt already. He is very well prepared to take on the CEO role. We have a very strong leadership team as well. And as we've been discussing, our finances have stabilized here. So we're in a really strong position. So it's a great time for us to go through that kind of a transition. It's going very well. We didn't want to rush that. Bob is very busy working on the transition, but it just felt like the time was right. So February 1, I'll hand him the keys, and he'll do a great job.
You also pointed out in that chat that you know each other, the history of the airline. You are actually very good friends. Your quote, I believe, was, you finish each other's sentences. It's a corporate bromance, I think, that will serve the airline well. But why was it important for you to go within, as opposed to perhaps bringing in someone, and I don't want to sound ageist, but someone who might have had a fresher approach, a younger approach, and go outside the company?
Well, I think those are fair questions, and you always have those pros and cons with a leadership transition like this. And I also intend to stay on. I'm going to continue to be involved with the company. I'll be executive chairman. I'll have some duties. I don't want to leave. I love this place, and I love our people. So I'm excited that I can continue on, and I hope it'll be for many years. So we have a good partnership in place. I think that the statistics are very, very clear that CEO transitions are much more successful when they are with internal candidates, because culture of companies is important. The business model here is unique and very important to our 50-year success and going forward. So I think we just have to surround ourselves with diversity, with diverse ideas, diversity of thought, diversity of backgrounds and experiences. So there are other ways to achieve that goal than with the CEO. But Bob is very deeply experienced in Southwest in a number of different functions. And that's invaluable as a general manager, so to speak, because, it's impossible for a CEO to be proficient in every single function. But the more functions you know, the better. And he'll be a great leader, and he's very innovative. He is very bright. He's very fast. He has a great capacity for work. And I think most importantly, he loves people, and he's calm, and he's steady. And all of the things that you would hope for in a leader, I think he's got. And, he'll have his chance and his shot, and we're going to do everything we can do to support him.
Getting back to the numbers, because I think a lot of us are rooting for all of the airlines to recover. You've guided for July revenue to be better than originally thought, only down about 10 to 15% compared to 2 years ago, August, perhaps 12 to 17%. Why not guide for September? Is it that uncertain given what's happening in the environment right now?
I think that, we still have a pandemic. We have a bump again in the case counts, and we've been in this rhythm for about a year of providing guidance that we're comfortable with, that we think is credible, in other words, about 60 days out. But hopefully we're in this down 10 to 15% range for the foreseeable future. The only reason that August is a little bit worse, if you will, than July is because there's a holiday timing shift. Last year, the Labor Day travel occurred somewhat in August, and this year it'll be all in September. So, hopefully September will perform in that same range. But just to give you some sense of the booking information, usually we'll start a month with about half the bookings in place that we would expect to get for that month. So while we're 45 days away or so from September 1, we still have a long way to go in terms of accumulating bookings, for flown revenue in that month.
And to wrap up, I promise you I will get it right when I write up this story about June's profitability without the payroll support. But what is the key, do you think, about this earnings report that you want everyone to know as to where Southwest is headed?
I think that that's really the key, is that the demand remarkably has recovered. It is very strong. It's very heavily oriented towards the consumer right now, and that is a little bit different. So I just, in terms of the messiness of this pandemic, just be aware that everything isn't optimized yet. It was messy going into the pandemic. It is messy coming out. We still have supply chain challenges, and our route network is different, and our customer is a little different. Consumers bring more bags. There are more transfers. There are more connections. And so it's just a little bit different experience right now. The airport experience is different because all of the concessions aren't open. And the lines are long. So it just requires a little bit of patience. All these things will smooth out, and the cost penalties associated with that will also get smoothed out. So we'll want to continue to run the best airline. That'll be our goal, to run the best airline in the country. And we have the best people, and they're working really hard. And I think the main thing is just to know that demand is back. And absent some change, it feels like it's here to stay.
Just to wrap this up, Mr. Kelly, it's Bob Jordan who said that the company is in great shape, pointing out to the cash break even in June, and we look forward to getting to know him. But as you pointed out in that June 23rd chat, you want to finish what you started, and the airline seems to be doing well as you've gotten through this really crisis that all of the airlines have hit. And we appreciate you joining us here on Yahoo Finance Live. All the best to you. Gary Kelly, CEO of Southwest Airlines.
AT&T shares little changed right now. That's even after the telecom giant came out with earnings per share that beat estimates and actually saw strong subscriber growth at the unit it's offloading. Of course, that is Warner Media. HBO and HBO Max subscribers rising to a total of 47 million. Let's bring in Craig Moffett to talk about all of this. He, of course, is co-founder and senior analyst at MoffettNathanson. It's good to see you, Craig. Thanks for being with us. We learned from AT&T and Verizon yesterday price war seems to be continuing apace, or should I say the promotional war continuing apace between the telecoms. Where does that end? What's the outcome of that between the two companies? They seem to be gaining from it, but how long can it continue?
Yeah, look, it's a great question. I think the real question right now is how long industry subscriber growth remains at these kind of stratospheric levels. I think it's a fairly non-controversial starting point to say that we're reasonably close to saturation of wireless in the United States. That is, we've very long been at the point where almost every adult has one. So you ought to expect, that being the case, that the growth rate in phone subscriptions is something like population growth rate. There's probably a little bit of a boost to that for kids getting younger as they get their first phones and what have you. But right now we're seeing growth at about 5 times population growth rate. And that is clearly coming from promotional activity that is giving customers an incentive to take buy one, get one free devices that they need to take an extra line on that they don't actually use. That's not sustainable for the long term. So what you're seeing right now is everybody benefiting during this kind of super normal period with stimulus checks and buy one, get one free offers. But when growth comes back to something like normal for the industry, I think it's going to expose some real weaknesses in the competitive dynamics of the industry, because AT&T is spending an awful lot to sustain the growth that they're getting. And in the last quarter, for at least 6 weeks or so, Verizon was too.
Craig, why do you still rate AT&T at sell?
Well, it's funny. We had been at a sell rating for, about 2 years or so. Actually, we put the sell rating on as soon as the Time Warner deal closed, and said the amount of debt they had taken on was ultimately going to be so debilitating that it would bring them to a dividend cut. And I used to say that I thought that once they made the dividend cut, that there would be an opportunity to buy AT&T shares and that it might actually turn attractive. Unfortunately, when they did the dividend cut a few weeks back, or I guess it's now about a month or so ago, when they announced about a 45% cut to the dividend, the stock fell, not quite as much as we had thought or even hoped to give a buying opportunity. But remarkably, their free cash flow guidance that they're basing their new dividend sustainability on is still probably significantly higher than they're going to be able to achieve. And so we came away from this thinking, as hard as it is to imagine, the dividend already looks like it is stretched even at the new roughly half the rate that it used to be. And so the stock still looks to us to be overvalued.
And Craig, your latest commentary on the stock, it's kind of outlining, okay, so they bought into maybe the media hype cycle at that top. Now they're coming back into wireless at the top of that cycle. What does AT&T look like? What could it look like? What can it even look like, in your view, 5-10 years out?
Well, it's a smaller and more humble company, that's for sure. The real challenge is that it's not like you can wash your hands of the media business and then say, well, what's done is done, no harm, no foul. There's been a lot of long-term damage to the business. The balance sheet problems that AT&T brought on in the Warner Media deal have meant that it is now way behind T-Mobile as we enter 5G. And I think that's a problem, frankly, for Verizon as well. Verizon did not skimp on spending. They have continued to be aggressive in trying to maintain their network advantage. But they made a big bet on millimeter wave spectrum. And T-Mobile now looks like they have pulled ahead of both Verizon and AT&T, and sustainably so, in network quality. And it's very hard when your prices are, 16% or so higher for the average phone package than T-Mobile's, and yet T-Mobile goes from having a weaker network to now in 5G having the best network of the three. The other problem for AT&T and frankly for Verizon as well is that AT&T has now, I think, quite ill-advisedly entered into a network wholesaling agreement to Dish Network that threatens to make Dish a much more aggressive and threatening competitor. And so the future competitiveness of the industry looks like it's getting worse rather than better at exactly the time that AT&T is pivoting back to wireless.
You know, Craig, to sort of circle back to my original question, then it sounds like this is all going to be maybe mean lower prices for consumers over the long haul, which is good news for consumers, but does mean a kind of fundamentally different kind of telecom business.
Well, I don't know, unfortunately, whether it's actually a fundamentally different type of telecom business, because the telecom business has been kind of a lousy industry for a long time. In a lot of ways, it's just following the segment that you just had with the airline industry. It's a lot like the airline business in a lot of ways, in that it has very, very low variable cost, high fixed cost. And so it tends to have a lot of volatility. But it's, I think we all grew up in a period where the wireless industry was a hyper growth business. It's not a growth business anymore. The industry grows at below GDP, and it has for a long time. And if you're Verizon and AT&T, you're in an industry that's growing at less than GDP, and you're a share loser. And that's also been true for a long time. That's a tough reality. And frankly, as an investor, it's a tough way to make money in those businesses.
Well, people aren't making money on those shares today, that's for sure. Thank you so much, Craig. Appreciate your time this morning and your expertise on this subject. Craig Moffett of MoffettNathanson.
Welcome back to Yahoo Finance Live. Well, we have seen short TikTok clips and Instagram posts garnering millions of clicks. But what about a feature-length film created by some of the biggest influencers? One company is looking to tap into that potential with a new platform that looks to finance and distribute movies that are created and directed by some of the biggest social media stars. Let's bring in Jonathan Shambroom. He's the co-founder and CEO of Creator Plus. We've also got our very own Canal joining in on the conversation. Jonathan, it's great to talk to you. This is kind of a fascinating idea because we've all sort of look at social media clips and say, well, that's sort of not as refined. We like how casual they are. How do you turn that into a feature-length venture?
Great question. Thanks for having me. It starts with our content studio and development team, and it starts with pairing a great story with creators. And Ben Grubbs, my co-founder and partner in this, we believe that creators can be phenomenal filmmakers and storytellers. And we surround them with an entire team, best practices from Hollywood, but in a lean model to bring a story to life, with all that support. And we look at, the creator economy today, a $200 billion market, and we see 1 billion people every day watching over an hour of video on YouTube. And we know that these creators, top creators, are resonating with large engaged audiences. And what we want to do is provide an opportunity for creators and digital storytellers to make that long form content and make movies.
Yeah, when we look at it, I suppose certain genres here of movies lend themselves maybe better to working with creators, or maybe not. Is there one you'd be looking at there, maybe comedy over action, or what's the ideal mix that you see shaping up for success?
We look at what a young audience, what a Gen Z audience, are most excited about today, and that is young adult content. It is romance, it's comedy, it's horror, and it's thriller, and all of those are in our initial slate. And I'm excited to share, we actually just announced our first film this morning, so that's in the news today, and this is a great example of something we're doing. Our first film is called Jane. It's a psychological thriller that peels back the layers of growing up on social media and the anxieties that teens face in high school today, with a star-studded cast. Madeleine Petsch of Riverdale is in the lead role. Chloe Bailey, 5-time Grammy-nominated singer-songwriter, signed on Beyonce's record label, is in a supporting role. Melissa Lee, Oscar winner for Best Supporting Actress in The Fighter, is in a supporting role. And Sabrina Jaglom, first-time director and writer, have this project. And that's an example of how we're giving the storytellers and creators, blended with traditional talent, this opportunity. But the through line is what's resonating with young audiences today.
Jonathan, this is also interesting because you guys are actually creating your own platform, but I'm curious how you plan to battle the big guys in this space, Netflix, Disney Plus, HBO Max, because we are seeing some of those influencers go over there. Addison Rae, for example, she's starring in the new She's All That remake for Netflix. So one, how are you going to convince influencers to partner with you? And two, how do you convince the fans to go and purchase those films on your platform when the odds are they probably already have a subscription to Netflix, HBO Max, or Disney Plus?
It's a great question. We're offering creators actually something that they don't have on other platforms. And it starts with our principles. We treat creators as equal partners. So we're financing and producing and distributing the films, but we're also giving creators co-ownership of the audience and insight into the audience, co-ownership of their IP, and an equal revenue share on the back end. After we've recouped expenses, creators and our company, we share the revenue 50-50. So it's a different opportunity with different economics for creators, and they get to stay in the driver's seat creatively. On the other platforms, there are high barriers to entry, and you typically don't own and have those insights into the audience. So we're placing creator first, and for the audience, we're so fanatical about their favorite creators. On our platform, the Creator Plus is a content studio and a new streaming platform across web, mobile, and connected TV. And we're able to then, craft a new experience that's immersive, that combines community and content and commerce in one place and offers additional content going deeper into story, into characters, into the community, and giving the audience a new experience, with their favorite creators today.
And, I've heard this in my own circles, but there are some critics of influencers who say, okay, maybe they can make a 15 to 30 second video go viral, but they're not necessarily actors. They're not directors. They don't have the training and the skills to do that. So what do you say to those critics that say, these digital creators are sort of cheapening the quote unquote real work that we have people like Leonardo DiCaprio, Steven Spielberg doing out there in Hollywood?
I disagree. We think that within the ranks of creators, there's phenomenal talent. And not all creators are the same. They're not created equal. They have different interests and different abilities. Within the ranks of creators, we see incredible talent as storytellers that have found voice that resonates with these massive audiences. There are 500 plus creators on YouTube that have 10 million or more followers, and much higher. We believe that surrounding a creator with a top team, production crew, writer, director, pairing them with a great story is going to yield some pretty phenomenal films.
So you're looking at roughly 6 films right now. And Jonathan, I wonder what the audience is that you're going for. Are you just going for the younger Gen Z audience that's already on social media, that's familiar with these stars? Are you looking to develop content to broaden it out?
We want to go well beyond that. The target audience is 13 to 29-year-old. And, a creator that's ideal to work with us, has passion for telling story and wants to branch into long form and make a film and has a large social graph. But what we bring to that is also our own marketing and, expanding well beyond creators, own audience. And our company, it's founded on story. It's creator first. We believe that stories are the lifeblood of the soul and, able to inspire and connect, and change culture. And so we're seeking to tell stories that matter. And again, with a slate, starting with 6 films, we get to focus on each film, and promote that. So to widen its reach, starting, with global English domestically, but with aspirations, globally as well.
We're joined now by Gregory Dacco, Oxford Economics chief U.S. economist, to talk about this economic recovery, but also some of those headline figures that we had out today when it comes to those jobless claims. So, Gregory, as I just mentioned, those headline numbers, 419,000, higher than those consensus estimates. But this is, of course, only 1 week's worth of data and worth of numbers. Do you see this really as a beginning of a trend, a one-off for this 1 week, especially as we see the Delta variant essentially surging across the United States?
Well, I think we have to be careful with any weekly number. We know that claims tend to be quite volatile from one week to another. The trend is actually already in place. Since May, we've really seen a flatlining of initial claims for unemployment at a level that is just over 400,000, which is good, better than we had over the earlier part of the year, but still not great. So we'd like to see that trend resume. But we're likely in an environment in which these claims are going to continue to fall, but perhaps at a slower pace going into the second half of the year, as we've probably passed peak growth for the U.S. economy and likely also peak inflation. So the dynamics are still good for the U.S. economy. The recovery continues to maintain a lot of momentum, but the momentum is actually gradually cooling, not accelerating anymore.
Greg, I want to talk a little bit about the recovery in the labor market and how that's playing out in different regions across the country. I know you took a closer look at this. Talk to us about areas of the country where the job market seems to be doing a little better than in other areas and why that is the case.
Yeah, we've looked at essentially the different trends across the labor market in the U.S. And what we see is that the southern and mountain states are actually doing relatively better. Some of the states that are more exposed to the leisure and hospitality sectors, like Hawaii and Nevada, are actually lagging in terms of the labor market recovery. And some of the big states along the coast, like California, New York, Texas, are essentially still in this environment of a gradual labor market recovery. And it's a couple of elements that are driving these different trends. First, and very importantly, it depends on mobility and labor demand. In some of these states, we've seen less reduction in mobility and therefore a faster reopening and therefore stronger demand for employment. But it's also a question of how rapidly labor supply is being released. We know that labor supply is a key constraint on employment growth, and that pertains to the virus fear, it pertains to childcare, it pertains to unemployment benefits. And some of these constraints are easing, and in some states, they've eased more rapidly than in others. And as a result, we're seeing stronger progress in terms of the labor market.
Yeah, Greg, I was looking at the list, and it seems like a lot of the Republican states right now are actually doing the best, at least when it comes to that labor market recovery. They also weren't as stringent in terms of their measures that they had taken throughout the pandemic, remaining somewhat partially open. As we are going forward in this recovery, do you see downside risks to that kind of policy and perhaps that labor market recovery perhaps tripping up as we see the Delta variant essentially spiking across the country, and now even this Lambda variant that we're hearing about coming up in Texas?
Yeah, I think we have to keep in mind that this economic crisis is first and foremost a health crisis. And so long as we don't have a long and sustainable health solution, we won't have a strong economic recovery. And you're absolutely right. Some of the states that have been doing better because they impose less stringent mobility restrictions or social distancing measures. But they're also the states that have the lowest vaccination rates. And so as we look into the second half of this year and into 2022, and we see these different types of variants, the Delta variant right now, but other potential variants going forward, we have to keep in mind that the health situation could deteriorate rapidly. The UK is a prime example of a situation that is deteriorating despite strong vaccination rates. So if you combine low vaccination rates in some of these states with a Delta variant, I think the risks are still quite severely skewed to the downside, and that's something to monitor very closely in terms of economic activity heading into next year.
So, Greg, what do you see as the main downside risk or hurdle for the economic recovery? If a little earlier you said that you believe we're at peak growth and peak inflation, so what is the thing that could really trip us up here?
The thing that could really trip us up is the health situation. We know that some are talking about inflation as being the key risk for the U.S. economy, but that's simply wrong. We have an environment in which we have high inflation because of this mismatch between demand and supply, but we also know that inflation is not going to run away. We're in an environment where inflation expectations have moved up, but they're still fairly anchored. So I don't see inflation as being a key concern for the economy. What I do see as as a key concern for the economy is an environment in which the health situation would deteriorate and in which there might not be as much appetite for fiscal policy support. That could become a key issue as we look into the fall and into the winter, an environment in which the health situation deteriorates, economic activity slows, and there's not much appetite for fiscal policy support could make for a bad mix for the U.S. economy.
I do want to ask, especially as you mentioned that fiscal policy and the support there, what you are expecting from the Fed. It seems like not too long ago, the Fed was everything that we were talking about. Some had even mentioned the Fed potentially as one of the risks to equities, at least moving forward. What moves are you anticipating going forward from the Fed?
Well, I think the Fed is in a situation in which it's observing an environment in which inflation is peaking higher than it wanted, but it also has the ability and I think the credibility to tighten policy should inflation continue to rise and continue to accelerate in a persistent manner. What we are looking for in terms of the next few meetings over the course of this year is essentially a situation where the Fed telegraphs its intent to taper its asset purchases starting in early 2022, but shows no signs of an immediate need to raise interest rates. And we think they won't raise interest rates until 2023. So a Fed that is very much attentive to the potential downside risks to the economy and the need to maintain accommodative policy as we still navigate through this recovery. And while we know that the recession was very short per the NBR's latest announcement, we also know it was very deep, and it's going to take some time for the economy to recoup its state of pre-COVID.
All right, Gregory Dacco, Chief U.S. Economist for Oxford Economics. Thanks so much for joining us today.
The founder of JetBlue just got another airline off the ground. It's called Breeze, and it touts itself as a low-fare, high-flex airline that is, quote, seriously nice. Joining us now is the founder of Breeze, David Neeleman. David, always good to see you. Congratulations on the new airline. I know it debuted with service from 16 cities, but there are lots of adjectives here that we're using for this. What makes Breeze, quote, seriously nice, and what do you mean by a high flex airline?
Well, I think, when I started JetBlue, that was 22 years ago, and times have changed since then. And I was called, JetBlue, a customer service company that just happens to fly airplanes. And with the changes in technology, we call Breeze a technology company that just happens to fly airplanes. And what does that mean? It just means that we're going to try and use technology all we can in our apps and our all of our processes to lower our costs and so that we can pass those savings along to our customers. And the goal is to get you there twice as fast for half the price. 95% of all of our flights are in markets where there is no nonstop competition. So our customers are loving the fact that they can get somewhere in an hour and a half instead of 3.5 hours and can pay $89 instead of, a lot more than that.
All right, so David, we're showing everyone on the screen some of those introductory fares, $39. And as you were just mentioning, tech obviously enabling you guys to really slash some of those prices. Curious to know how long those $39 fares are going to last. When do you envision them jumping, and what do you think they're going to jump to?
Well, I think, what's key is that in our markets where we're flying, we need to make the market 10 times bigger. There may be only 5 or 10 people a day traveling, maybe between Huntsville and New Orleans or between Charleston and New Orleans. So we need low fares to stimulate that traffic. So we're always going to have low fares, something, 79, 89, 69, 59, 99, they're always going to be low. But then also you'll be able to find a $39 fare, not just in the introductory, but, in the future as well. So it's all about stimulating traffic. Like I said, about 90% of all of our traffic comes from generation as opposed to, taking from someone else. And, we like to generate new traffic and get people going places, and especially kind of post-pandemic, and people are looking to get out and travel and see new places and experience new things, taste new foods and see new historical sites like Charleston. And so it's pretty cool to watch
You mentioned the pandemic. Interesting timing to start a venture like this when travel has, sort of been under attack because of the virus. Why did you choose now to do this, and what has demand been like here in the early going for Breeze?
Well, we chose to do it before the pandemic, and so we put things on hold and just kind of waited it out. And we had our first flights last month in May, and I think the timing is good. I mean, obviously there's concern about Delta variant and other things, but thank goodness we have a vaccine, and people who are vaccinated and feeling comfortable. I have an 87-year-old mom and dad that got vaccinated, and they've been able to see their grandkids and travel and do some things that they've wanted to do for a year and a half. So I think getting the vaccines out there and having people take them, and I think there's a lot of concern about people who aren't vaccinated. And my opinion is, people who are vaccinated should just travel, and worry. And the fact that the data shows, even with the Delta variant, that you're safe. You're not going to be in a hospital, or you're not risk of dying with the vaccine. And so the timing is really good.
So we've been seeing the TSA screening more and more patients, not patients, more and more passengers every single week. When do you think that we're going to start seeing the demand, but also those air traveler numbers, essentially get back to some of those pre-pandemic levels and sustain that?
I think on the leisure side, they probably exceeded it. They've already gone beyond pre-pandemic because people saved money over this time. There was, maybe $1.6 trillion that was saved on travel that now is being spent. The bigger question, I think, is when is business traffic coming back? And I'm seeing office buildings now, starting to fill up again. People are going back to work. They don't have to do it with a mask on, and so I think once people go back to work, and I've heard one of the airline CEOs say, once you lose a customer because somebody else visited them in person and you didn't, then you're going to get back on an airplane again. So thankfully, we're not in the business traffic market, especially international business traffic, where you get those $5,000 and $8,000 tickets that really sustain, those airplanes. We don't have to deal with that, but I think that's the big question. The leisure traffic's back.
And you're also busy buying up some airplanes. Tell us a little bit about those purchases, David.
Well, we've got the Embraer 190, 195, 108, 118-seat aircraft that we're flying now. We've got 13 of them flying. We'll probably get a few more by the end of the year. But then in October, excitingly, we're going to start getting our new Airbus A220s right off the factory floor from Mobile, Alabama. And those planes are unique because they have a really long range. We're going to have some first-class seats in them, and we're going to be able to go up to 7-8 hours of flight time eventually. And there's just a lot of different markets that we can serve, long, thin markets that have never had nonstop service before on a long-haul basis. So we're excited about both products, and our customers are going to love it.
Hey, David, I know I'm really jumping ahead here, but long term, do you see Breeze making a debut on the public markets? Would that be the end game for you and your investors?
Well, airlines have always been a high capital intensive market. And, so that's why, most all of them are public. And, I would think that would be an eventual outcome. But, we've got, plenty of capital, and we can go for, a long time. And we expect to be profitable next year. So, it's not something that we have to do, but, I'd assume that could be a possibility someday.
It's a nice position to be in. David Neeleman, founder of Breeze Airways. Thanks. Good to see you.